Alright, so this video is on which time frames are more important and which ones are not as important. So as usual, you want to just look at the big picture. I usually start with a monthly, and I'll go into smaller time frames in terms of entry and stuff. But you just want to define the overall trend, So see if an uptrend, which is uptrend, go higher high, higher lows, downtrend, lower low, rise, lower lows. So here's just your basic premise of what forms a trend and whatnot. So we know that uptrend is higher highs, higher lows, downtrends, lower highs, lower lows. If you go onto my website and you look at the how I identify my structures, I teach the 4 structures that I look for in terms of candlestick patterns. So here's just a monthly on Facebook. Over here we had our high of 220, and then we had a big sell-off all the way down to 119. So we got our high here, and then we have our zone here, a drop, base, rally. So what confirms the power, or I guess strength, behind a level, so this level, so what really confirms it is it has to break a pivot high. Okay, so I'll call this just a monthly demand zone. Let's call it monthly demand zone. And I'll put in parentheses GBR for drop base rally. So we know this is a drop base rally, but it's not really confirmed until we break this pivot high. Or it is confirmed, but it's the strength of a level is determined if it can take out highs. Prior pivot high. Right, so we get this level of form here at so here's a monthly imbalance, drop base rally, drop base rally, and then we get the level of form right here, set of level forms, and then you get a big move out of the level. But look at what it does. See, it actually takes out the high right here. It makes a higher high right here. So what that tells me is that there is enough buyers in this monthly demand zone right here to actually take out prior resistance. So that almost in a way actually confirms a level, because if an imbalance can actually take out a prior high, it's obviously got a lot of demand there to actually break past where the sellers are actually holding the market up. So so we know it made a higher high. So strength of level on all time frame more powerful if it can take out a pivot high. So this is a perfect example right here. Okay, so this level right here took out this high, and then we came back and in a resistance sold back off again, but look at where we sold off into. We corrected down into the monthly imbalance right here, and then they took price up higher. So obviously we know that this is higher highs, higher lows. So ideally, we want to be getting long on corrections into demand, or works on all time frames, obviously. But this is just a monthly view. But I'll even go into but I'll show you how I sort of do like a top-down analysis and stuff, and then how you can quote unquote refine. So if I know that this is a monthly zone, right? My box is a monthly demand zone. We can actually refine by going to smaller time frames, and then you look for the same structure, right? So within this zone, so within this 21 point zone, where do you see an imbalance? I see an imbalance right here. That is a, whoops, that is a rally base, rally imbalance within the monthly zone. Right, so we see this is a monthly imbalance. So a lot of people, what to do if they're swing traders, they'll actually take a starter position at the proximal line, which would be 143 here, and then they'll start to scale in appropriately, and then and then you would take a partial at the weekly imbalance, which is the close. So the weekly imbalance would be like here, the close to, I guess, the wick lows. So this would be like a weekly imbalance right here. So right here, we refined it in here, and then a rally-based rally is nothing too fancy. It's simply you're gonna move up, and you get some sideways movement, and you're gonna move up. So then so the demand really resides right here, right? Because think about it, if price can rally, and then it can base or pause to consolidate or accumulate, right? And there's enough demand to actually break it out of this equilibrium right here, to pop it out of this level. Well, the idea is that there's obviously enough pent up, or the idea is that there's enough, is that demand exceeds supply here, so that the next time you get price to retrace for liquidity reasons or to pick up more buy orders, you actually want to be looking at getting long again in anticipation of price moving back up. So that's an example of refining, and then you could see actually hit it almost to the penny, but you can see the wick comes in here. Wicks represent effort to fill orders. So you can see right here, it pulled right into the monthly zone, but then it went into the weekly imbalance to fill those orders. And then from there, price took off. And then look at what happened as a secondary event. So you get your reaction 1, bounce out of monthly demand. Let me delete this stuff. 1 second. All right, so you get your reaction, or I guess I can call it reaction 1 or event 1, but you get our initial touch into the level here, and then we start to form some more levels of demand, which are other opportunities to get long in this name. So here, right here, you get another drop-based rally formed as a result of the level. You get another drop, base, rally. So now I can delete these. So I'll keep the weekly imbalance in here. So we know that this is the weekly imbalance. Rally base rally weekly. So we know that out of this level, we formed another drop base rally as a reactionary event from the monthly imbalance. So knowing that, we all know how to draw the levels if you watch my videos enough. It's pretty subjective, but I do have a particular way of how I like to draw them. But here it is. Here's almost like the engulfing setup. So I would just take it to the open of the bearish candle, because there's obviously no other smaller base to play off of. And then I draw a box like this, and this is almost like a secondary event. So reaction 1, you get the bounce out of monthly demand. Reaction 2, drop base rally demand forms as a result of reaction out of monthly demand. And then you can see right here, let me delete the black line. But we form the imbalance right here, and then you can see the wick right here comes and tests it. And then from there, price just rallies upwards. So remember, you get your reaction 1, you get a bounce out of the monthly demand zone, and then reaction 2, you'll typically see smaller time frame demand form as a result out of a reaction of a higher time frame level, and then you'll always get a pullback back into the reactionary level, because basically the idea is that there is enough demand here to actually reverse price at this particular price point. So they're going to actually have to manipulate price lower, and they're going to actually have to trap more short sellers, because remember, at this point in time, Facebook had sold off hard, and the 99% of people, their idea is they like to sell after a big drop in price. So what's going to happen is on this relief bounce here, you're going to get people trying to short, and they're actually selling to institutional buyers in this level. Let me pull up some volume, I bet. Let's see if we get a volume splurge down here. Volume. Where are you, volume? Okay, so you do. All right, so look at this. Look at the volume here. Look at all this volume. So here's, so just think about this for a second, okay? Here's all the volume, you see. So you get elevated volume equals institutional activity, because only institutions can produce a volume bar like that. See, this is all institutions are inactive. You see, you get some activity here, but this is all institutions are actually inactive, and then they start to, then you get the liquidation, and then you actually get the massive volume splurge. But look at where the volume comes into, though. The volume hits right here. So think about it. You have participants selling after a big drop in price into a level of demand. Who's on the other side of the trade? Remember, every buyer there's a seller, every seller there's a buyer. So for there to be this much activity into a level of demand, and then it can print that kind of candle, that tells me that you get the big boys actually absorbing those sell orders. So the volume will tell you a lot. Anyways, where was I? Okay, so you get the drop base rally right here. You get that forms as a result out of the reaction out of a higher time frame level, and then they come back. Oh, you can see the wick right here, or I can go into a daily chart and you can see it too. Yeah, right there. See? You see that come back, and then so the weekly imbalance forms, and then they come back right there, pick up more buy orders, and then from there it takes off. That's probably a wave 2 as well. Yeah. So anyways, you get that move out of the level, and then you start to establish a trend, right? Because like I said earlier, uptrend is higher highs, higher lows. Then you start to establish trend as we make higher highs and higher lows. And as you can see, it's been doing this for quite some time now. So the bears really don't have any confirmation until we do break a lower low, which this actually would be key support now, because this is the most recent pivot low. So anyways, back to the question in terms of time frame. You want to be able to establish trend, which in Facebook's case, we're obviously making higher highs and higher lows. So we obviously want to be looking at getting in on pullbacks into demand. So at this point in time, how could I have played it? Let's go back whenever the weekly imbalance formed. Back in just this time period, okay? Right, so back here, it formed the reversal setup. So how can you, or how could you have caught it? So you know, like I said, you want to pay attention to trend, higher highs, higher lows. So then you want to be looking at getting in on pullbacks into demand. So, you know, I use daily or 4 hour, but I like to start with the weekly chart to plot my levels. And then from there, so on weekly, I'll plot my boxes. And then on a daily or 4 hour, I will plot my zones. So here's an example of some demand here. So you get price to rally, right? And then you get some cluster here, right? So what does this turn into? This turns into a drop base rally, right? You get some demand over here, and this, you get pent up demand there. So again, I will look for the open of this red candle, because obviously there's no other doji or anything else to play off of, but I will take this open here and I'll extend it out to the lows, and this is a 4 hour drop base rally demand zone. The idea is to buy on a pullback into demand. And you also want to make sure, counter trending is obviously always risky. And, you know, it works. You know, for example, you know, here's a rally based drop demand zone right here, and it worked. You know, it pulled it back, but you know, dips got sucked up again. So, you know, counter trend, you always have to be aware of the overall trend. So, see here. Here's some demand, or here's some supply here, and then you see it absorbed over here, absorbed, and then you got the pullback, but it pulled back right into demand right here, right? So as you can see, trend was respected, and it did print a higher low. But here is the drop base rally, and then you can see it forms the imbalance, it takes off, and then you get supply to form here. You get supply to form here, right? And then the market tests the supply, and then it fades back down, but look at where it fades into. It fades right back into the demand that was formed over here. So again, there was enough demand here to actually form this sort of structure and actually print a higher low. So what happens is price gets, I'll type this out. So price forms an imbalance, takes off too fast for them to fill all buy orders. So this right here, an example, takes off too fast for them to fill buy orders. So then you get the pullback into demand for them to fill orders that didn't fill originally because price took off too fast. So this is a prime example. So it forms supply here, right? So you get the supply to form here, and then you get the little pullback, and then they pull it back up into supply here, right? That formed, and then the supply makes it fall back into demand. So you can see that the market is literally moving from supply to demand, and until it can breach a lower low, we need to respect the trend, because in an uptrend, demand gets violated. Let me type this. So focus trend, in uptrend, supply gets violated because it makes higher highs, lows. So right away you're already at risk if you try to counter trend short in an uptrend, because you run the risk, you may be able to catch a pullback, but you run the risk of getting squeezed because the overall trend is up and dips into demand get bought until proven differently. So here's an example of a corrective move again. It forms demand here, rallies, forms supply. Right here, you get the pullback, you get the imbalance to form, and then you get the relief rally into supply, or the corrective ABC, three-way move. You get the A, B, C, corrections move in threes into demand, and then you get another move up. So now let's see where we could have caught another entry if we were day trading and not swing trading. So here you get a move up, and then you get a pullback down here. Where are we? Daily, okay. Okay. We can use all time frames if you want. It's all up to you. I'd basically just look for the particular structure. So if you go onto my website under the 4 key structures I use to identify these levels, that is where you will find it. Anyways, so here is another level right here, right? So you get the price rallies out of the level here, rallies out of demand, rally, and then you get some pausing slash price stall sort of here, right? So you get price to rally up, and then it pulls back down, forming a low, and then it rallies back up. But look at what it forms though. It forms a drop base rally imbalance, right? Because if price rallies and then it drops here, and then when I say base, it's basically just a pause. Okay, so it's like a big or it's a move, it's a base and a pause, move, base, pause, and then you get the rally out. So obviously there is enough demand here to actually print this sort of candle and to actually form this low. So again, I would draw my level. There are a couple ways to do this. It depends on how close we are to the extreme lows, but I'll usually take the open of a green candle here, and I will just draw it, or I'll extend it out to the lows because, like we said, higher highs, higher lows, obviously. So this low actually becomes important. So it forms this level here. Drop base rallies, demand zone, forms that. Price rallies out of this level. So this would be the origin almost right here. This would be the origin of a move because you get a drop, a base, and a rally. So the rally didn't really begin until this origin. So you get the rally out of the imbalance that forms. It probably ran into some supply here. I could probably draw it. Yeah, it did. It ran into some supply here. But anyways, it rallied and then it faded. But look at where it pulled back into. Pulled back into 4-hour drop base rally demand. You can go into like an hourly or 2-hour chart and stuff and try to get a very good entry. But it all depends on your risk profile and if you're swing trading it or if you are day trading it. So you get the rally, you get the pullback into demand right here. You get people selling after a drop in price into a level of demand right there. And then you get the gap up because they all get squeezed to death because they were shorting after a drop in price into a level of demand. Then you get the gap up. So again, this level would be a bounce level if Facebook were ever to return here later on. This would be a bounce spot because this is a rally base rally. So this would be demand. So if Facebook were to ever return in here in the future, I would look at getting long. If Facebook ever sells off into this level, it's a fresh quality level enough to cause a continuation gap. So if it ever pulled back in here, I will be looking to get long with the anticipation of it going back upwards. Here's another level here, guys. So now we get the move up out of here. But then look what happens again. You get the pullback. You get a drop, base, rally. If you actually say it out loud, it actually becomes it becomes easier to spot. Think about it. You get the move up, and then price pauses here, right? You get a drop, price bases, and a rally. So for price to pull back from 209 to 197. So for price to rally up here and for it to pull back base and rally again. And I remember this level here, it broke this high. Remember what I said earlier about how it's all important on all time frames, how you want imbalances to break previous highs. Well, it broke this high, which almost confirms the level. It actually confirms the level of demand, and it would be something I would look to be getting long at because it did break that high. So we know that this is a drop-based rally, so we know how to draw the levels. You could take it from this bearish candle here, or you could take it from the body of the basin candles here. So for simplicity reasons, I'll just go from the open of the most recent bearish candle here. Now we'll extend it out to the lows, and we know that this was a drop-based rally demand. Right, here's the imbalance here that forms. So again, price basis forms the imbalance here. It rallies because there's obviously enough demand at this base to break the high and to rally. So again, you get another pullback, and it pulls back into demand again. So if you notice, when price gets too overextended from these imbalances, you get a reversion to the mean almost. It's like someone who trades using moving averages, and they get, it gets too overextended from the 5 or 10 or whatever they use. You will typically get a reversion to the mean, but using this style of trading, I can actually pinpoint price points, and if I can find confluence with, I don't know, fibs, or if it's a powerful level that meets the criteria where I would be looking at taking a position, then they are pretty high probable setups. But after 3 continuation patterns, it starts to get a little stressed out, and you start to get a little overextended overall. So, that's when Elliott wave comes into play, because that's when you can identify when a move is getting too overextended and when you can actually expect a corrective move. So again, a lot of people try to short every supply they see in an uptrend, and you need to realize that in an uptrend, higher highs, higher lows, supply gets validated, supply gets invalidated, because obviously it's making higher highs, higher lows. So here is some supply here, but look at what it did though. You see, this supply only caused a pullback right here. So it just caused some churn. See? So the supply didn't really do anything. So that's why, you just want to be very conscious of the bigger picture trend. That's why I don't really dial too much in on smaller time frames unless I'm trying to high frequency scalp the ES. But overall, you want to really pay attention onto the big picture and then figure out what's going on. So until we can break a low, so you get low, higher low, another low. Let me delete these pictures. Another low forms. So until we can really breach a prior low, there's really no reason to be looking at, so to speak, going heavy or trying to short swing something, because really you don't really have any confirmation of bears really getting into control until they can break below a prior swing low. So while I'm here on Facebook anyways, we actually caught a pretty nice short here yesterday, but it still looks very corrective. I mean, you get this flaggy action here. You get a clear 5-way move down. 1, 2. 1, 2, 3, 4, 5. This is 3 here. Sorry, I'm just doing this real fast because obviously I don't want to keep you guys on video for an hour. Well, but I'm just going to show you Facebook and then how I sort of see how things move. So corrections tend to move in threes. Well, they do move in threes, sorry. Yeah, corrections move in threes. And they like to retrace to the prior wave 4 of a lower degree, actually. So what happens is what I'll do is I'll go on to, so on this daily chart, right? You get this move up here, but you see, when you see this sort of structure on a higher time frame, chart, I mean, it says a lot, because look at this. You get this rally, you get the base, and then you get enough demand here to actually cause Facebook to actually gap up like that and just take off. So we know that there's demand here, right? It's a rally, base, rally. And if you go over my my Word documents, we know that rally-based rallies are opportunities to get long on pullbacks into demand because these form an uptrends. So I know that this is demand here. And actually, you can actually see some more confluence here of prior supply turned into demand here. Or I guess support turned resistance, something simple here. See, so we know this is a pretty important area, but I can actually, or I know where price, or I can identify where price will go to, and I like the structure right here, this rally-based rally here. So knowing that this is demand, let's call this a daily imbalance. I like the risk to reward here, and then this is, so let me delete this, and then this becomes, let's call this critical supports for bulls. So the idea is that I'll share this in the morning with you guys, but we're obviously in a corrective mode. But if this holds true and this count is correct and my analysis is correct, we should see a 3-wave move down. So we've got our A down, we had our B up last week, and then we should see another C down into the imbalance. And actually, if I actually measure the legs, yeah, you see you actually get perfect confluence into the level. Okay, so with corrections, wave A and C tend to have equality. So we get our 1, 2, 3, 4, 5 down. So we get our A down. Then you get your A, B, or you get your A up, B down. Oops, lowercase b, and then you get your B up. And then in theory, we should see another 1, 2, 3, 4, 5. So we should see another 5 waves move down, or 5 waves sequence moving down, because we know that A and C comprise of 5 waves. So you get our 5 down for A, 3 up, 1, 2, 3. You get your ABC up for B, and then we should see another 1, 2, and then we should see another 5 down. So knowing that this is demand here, I measure, because typically in corrections A has equality to C, you can actually take the high of where A begun, or where you think it begun, and this is I guess counter trading, because we are in an uptrend, but there are safe ways to actually play it if you can identify wave counts, or if you just play simple flag patterns. So I take the high and then I extend it to the low, and then I extend it up to the B high up here. And then I'll take out this nonsense because we don't need this stuff. And a typical retracement will go 78.6% to 1.236. If it goes past 1.618, then your count is actually incorrect. But what I do is I actually look for confluence with my imbalances. So if I know that this is demand, and if I do know that a typical corrective ABC move where A has equality to C in length. Right, so I'm not going to assume, but I think that we should see a move down into demand here, because we get some confluence with the 100% fib level. Right here, you get confluence with the 100% fib level at the 212 level, right, with the daily imbalance, right there. So we should see something like this, and then I think that Facebook is going to be rallying up for one more high. So I think that we actually do bounce out of this level, and I think that Facebook takes off for one more high, where it will complete a 5-wave move, and I do suspect that it'll see some damage. So in terms of time frames, because I know a lot of people ask me what time frames I suggest. You know what? I suggest them all. If you find the structure on a higher time frame, it's going to obviously hold more strength. So, for example, this was Netflix a couple weeks back whenever we caught the move. Let me clear this stuff up. But here's Netflix whenever we caught the move. Oh, the indicator I use for pivot highs and lows is just pivot high and low, and I use wavelength 10, because if I use 5, it'll show way too many pivots. But just from like a plain chart perspective, you can just see. So what I just showed you guys with Facebook, it's the same stuff. Same stuff. Here you get the drop, base, rally at this imbalance right here. Right, so I draw my box up here. 1 second, guys. Okay, so again, I draw my box there. Price rallies because the demand forms. They manipulate it lower into the level, and then you get the move up out of demand here. The move up, up, and then you get another one to form here. Same thing, it forms another drop base rally. Forms it, rallies, pull back into demand here. Same thing, back up. Some really powerful structures. You see, this is like a lot of chop and a lot of crap. It's not very quality. This is quality. When you can find something like this, we actually took this a couple weeks back, but this is actually very quality, because look at how price acts, okay? Price takes off, rallies hard, it bases right here, but then it rallies again. So price did not stay in this area for very long. Price couldn't stay in this area for long because too much, or because excess demand. You see, so this is a very quality zone, and we actually took it a couple weeks back. But again, rally, base, rally. So I would take my tool, and look at what happened. This was a very sweet trade, but same thing. Price forms the imbalance, forms a rally base rally, pulls up, and then it pulls back down to the level of demand here to complete the corrective move there, and then you get the move back up, making a higher high. You can, on all time frames. I mean, look, here's another one right here. You get another level right here. I mean, this was a decent scalp, but when you're buying, when we're this overextended after a rallying price, this is a very quality level, because as you can see, price could not stay here for very long at all. And again, Netflix, the bears are not in control until Netflix can actually break this low. So again, this is the most recent swing low. So if bears can break below that, they've got some room up. But same thing here, there's no way set in stone on how to draw the levels. It's all about your risk tolerance, and you got to figure that the strongest levels reside near the pivot lows and highs, because only banks and institutions can form pivot lows and highs. You see a rally base drop. So, for example, in this case on the 4-hour, I would just take the open here, and then we form this demand here, price sells off back into here, and then we're starting to rally a little bit, but it's definitely getting a little weak. You can look at the volume too, and you can see volume sort of dying off. But again, all time frames are very important. Definitely very important. So you see same thing here, guys. On a weekly, drop base rally. I'm sure I can go into a smaller time frame and actually find the actual imbalance, but here's like the basing candle on the weekly chart. There. Price forms the demand here, takes off, and then you get, months later, you get the pullback into demand, and then it just rallies really hard. So I hope this helped. If you have any questions, let me know. But in terms of how I draw my levels, again, if you look on my website, I have videos and I also have Word documents where I explain the structures. There's 4 of them: drop-based drop, rally-based drop, rally-based rally, and drop-based rally. So there's only 4 of them, and the premise behind this idea is that price only moves for one reason. Or I guess price moves for 3 reasons. Price moves because supply over demand. Demand over supply, or it doesn't move and is in balance and trades sideways. So that's sort of the premise behind of how I trade, and if you think about it, it actually makes a lot of sense. And I think that's it. So if you guys have any questions, let me know, and I hope this helped. And in terms of the time frame, every single time frame is important. You know, it just really depends on how you're trading. Are you day trading? Are you swing trading? It just is really dependent. But what matters is you zoom out and you look at the big picture and you establish a trend, so you make sure that you are on the right side of the trend.